The nation is in an economic crisis. To solve it, the Federal Reserve is printing money. Lots of money. Is this really a good idea? Welcome back to America Uncovered. I'm Chris Chappell. The U.S. economy is facing an unprecedented crisis because of the coronavirus, thanks in part to the Chinese Communist Party covering up the coronavirus for more than 6 weeks when they could have stopped it. Instead, it spread across China and now around the world, including to the U.S. To keep Americans safe, businesses large and small have been forced to close. Temporary unemployment is through the roof, and everyone's pocketbooks are hurting. Whatever pocketbooks are. But don't worry, the U.S. Federal Reserve is coming to the rescue. Maybe. Matt Gnaizda tells us more.
Thanks, Chris. The coronavirus has actually caused the U.S. to face two economic crises at the same time. One is the Main Street crisis. A lot of small businesses have been shut down and are forced to lay off workers. I'm talking about bars, gift shops, and even that $99 full-body wax place. There are a lot of hairy people walking around right now. The other crisis is the Wall Street crisis. The stock market has dropped off a cliff, but arguably even more important is the credit market. That's the $100 trillion market to buy and sell debt. If you have a mortgage, a car loan, a credit card, that's all part of the credit market. The credit market has dried up. That means local governments, businesses, and people have a hard time borrowing money because no one wants to lend money right now in these uncertain times. Basically, from Main Street to Wall Street, people need money. And that's where the U.S. Federal Reserve steps in. The U.S. Federal Reserve, also just called the Fed, is America's central bank. And to solve the Main Street and Wall Street crises, the Fed's plan is to print money. Now, technically, the Fed doesn't actually print money because they mainly just issue it electronically. And when there is physical printing, that's all done by the U.S. Treasury. And also because this stuff is technically not money, it's just currency because it's based on debt, not value. But that's not a rabbit hole I want to go down in this episode. But for simplicity, the Fed prints money. Now, while that may sound crazy that the Fed is allowed to just create money out of thin air, it is crazy. But that's also not a rabbit hole I want to go down in this episode. My point here is that the Fed will be printing trillions of dollars now, with the goal of shoring up the credit market and other parts of the financial system that have been derailed by the coronavirus. The Fed's technical term for printing massive amounts of money is quantitative easing, or QE. Here's a regional Fed chairman on 60 Minutes a few weeks ago, trying to reassure Americans that America won't run out of money.
And there is an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system.
An infinite amount of cash, that's reassuring. Or terrifying. Try not to think about it. Anyway, the Fed has a mandate from the U.S. government. Maximize employment, keep prices stable, and keep interest rates moderate. So ever since the Fed was created more than 100 years ago, it has added or removed money from the economy, mostly in small quantities, to keep prices stable. Over time, though, the Fed has ended up adding a huge amount of money, which is why we have inflation. That's why when my dad was a kid, a Hershey's bar cost a nickel, and now it costs $1.25. But it doesn't matter, because nobody buys Hershey's bars anymore. We have much better candy now. But my point is, the total amount of money in the U.S. economy, as measured by M2, was only $22 billion in 1913 when the Fed was created, and now it's more than $16 trillion. In theory, as more money gets added to the economy, prices go up because each dollar buys less. In reality, it's more complicated because the population grows and because new dollars don't get spread evenly throughout the economy. People in the U.S. have gotten used to gradual inflation in consumer prices, usually about 2% a year. The Fed has worked hard to maintain this moderate rate of inflation for decades. Even moderate inflation, though, comes with its own problems, but that's not a rabbit hole I want to go down in this episode. What nobody wants is hyperinflation. That's what happens when a central bank prints too much money too fast. That happened in the socialist paradise of Venezuela. Corruption and stupid government policies wrecked the economy. Eventually, the government couldn't raise enough through taxes, so they just printed more currency to pay for stuff. A lot more. But that made the value of the Venezuelan currency plunge. At its peak, inflation there reached more than 1,000,000%. A well-educated and once middle-class people saw all their savings turn to dust. Well, actually, they saw it turn to toilet paper. And a lot of Venezuelans can't even afford food now. Nobody in the US wants that model. Well, almost nobody. The Federal Reserve is keenly aware of this danger. They have a massively powerful tool. They're the ones who choose how much money gets printed. And with great power comes great responsibility. That's the Federal Reserve Chairman. Yeah, probably not a face you'd know. Anyway, doing quantitative easing, or QE, is risky. The Fed has done several QE injections before. In the period from 2008 to 2011, they eased about $4 trillion new dollars into the economy to deal with some of the fallout from the recession. The good news was consumers did not see massive inflation. The Consumer Price Index, which tracks the prices of consumer goods like candy bars, saw a roughly normal amount of inflation, or 1 to 2% a year, which means prices increased by just under 19% over the last 11 years. The bad news was some prices don't get tracked by the Consumer Price Index. I'm talking about asset prices, like the stock market, high-end art, and other things rich people invest in. And the Fed's QE did cause inflation in asset prices, massive inflation. Here's the US stock market. It grew by a whopping 225% in that same 11 years. All that happened because of the way the Fed did their QE. When the Fed printed money out of thin air, metaphorically speaking, they used it to buy assets whose prices had fallen, things like stocks, corporate bonds, and something called collateralized debt obligations, which included home mortgage loans repackaged in complex ways. The value of all those assets had ballooned before 2008, and then the balloons popped. When the Fed did QE, it pumped new money specifically into those assets. In the period between 2008 and 2011, the Fed printed about $4 trillion of new currency, which again ended up inflating asset prices, but not really the price of consumer goods. So people who already had enough money to invest in stocks and other assets got richer, while everyone else stayed roughly the same. And that's one reason why the wealth gap in the US has increased. And now with the 2020 coronavirus, the Fed is promising to do another round of quantitative easing. How much? They've already announced $700 billion in bond purchases. And by the time this economic crisis is over, the total QE could be in the ballpark of $5 trillion. So that's a lot. It's 20 times more than the $250 billion the government will be giving to individuals in those stimulus checks, which have still not arrived. Of course, the stimulus checks are not from the Fed. Those checks are part of the government's recent $2 trillion stimulus package. But ultimately, it's all going to be paid for by printing money. Now, I'm not saying the Fed should do nothing during this economic crisis. After all, with great power comes more work for our graphics guy, Seamus. But it also means that with this new QE, the Fed has to be careful, or we could see the same kind of asset inflation we saw a decade ago, which mainly helped the rich get richer while everyone else's money lost value. But as bankers like to say, it'll be different this time because we've learned our lesson. Which incidentally is the same thing I used to say to my third grade teacher. But at least Mrs. Reynolds saw right through it. This Fed press release from March 23rd details what they're going to be pumping money into. Now, they use a lot of complicated language to make sure you don't understand what's really going on, but I'll try to break it down for you. The things the Fed is pumping money into include Treasury securities, basically government bonds, and that keeps interest rates low. Mortgage-backed securities, which is the repackaging of real estate mortgages, which led to massive problems in 2008, but surely it won't now, for some reason. Corporate bonds, basically the debt of large corporations, so this is a type of Wall Street bailout. And exchange-traded funds, which are listed on the stock market, which is another type of Wall Street bailout meant to make the stock market go back up. So all that sounds roughly the same as a decade ago. And as they say, if you do the same thing over and over again, it'll be different this time, I swear! But the Fed has some new programs too. Those include using QE to support states and cities that need to quickly raise money by issuing bonds. It's unclear what impact this will have. And perhaps most revolutionary is the Fed's new program to help small businesses. This is critical because small businesses provide about half the jobs in the U.S., and they're also the ones hit hardest right now. So the Fed and the Treasury Department have teamed up on a program to finance small business payroll loans. The goal is to help businesses with less than 500 employees not have to lay people off. The loans are designed to cover about 2 months of payroll expenses and other essential costs, and can be forgiven if businesses maintain the size of their workforce. So the loans are super cheap, only 1% interest. And if a small business doesn't lay people off, then they won't even have to pay back the loan. So it's actually free money, which means, oh my gosh, it's a Main Street bailout. That's incredible. Even though it's only $350 billion, which is less than a tenth of the Fed's overall potential QE, but hey, I'll take $350 billion for small businesses either way. If the program works, that is. See, the QE that bails out Wall Street is done entirely by the Fed, with no government oversight. But the small business loan program is a lot more complicated. It's part of the government stimulus package, and the rules are outlined in the 90-page congressional legislation. That might partly explain why, so far, it's off to a bumpy start. The loans have to be done through the private banks, and the banks are not all cooperating, even though they should because they're all getting a frickin' bailout from the Fed. Many of the nation's biggest banks, including JP Chase, Citigroup, and Wells Fargo, weren't yet ready to take loan applications. So when the Federal Reserve tries to bail out Main Street, Wall Street doesn't seem to be that keen to help. Shocker. But if these small business loans do get off the ground and work smoothly, it will probably help the economy recover faster than anything else. And we may even see a slightly more even distribution of quantitative easing this time. Most of it will still inflate asset prices and help the rich get richer, but a portion of this new money will go directly to small businesses and by extension to their employees and customers. And that means we'll all get to enjoy some of the Fed's inflation. Back to you, Chris.
Thanks, Matt. So what do you think? And what financial rabbit holes would you like Matt to go down next? Leave your comments below. And America Uncovered continues to pay our staff full wages during this crisis. But to do this, we rely on the support of viewers like you. So go to patreon.com/AmericaUncovered and contribute even $1 per episode. It's a huge help. Once again, I'm Chris Chappell. See you next time.